Welcome to our channel. Today, we're diving into a topic that's at the heart of financial decision-making: risk versus reward in investment options. This is a concept that every investor, whether novice or seasoned, grapples with when determining how to grow their wealth effectively. The goal is to balance potential gains with acceptable levels of risk. But how do we achieve that balance? Let's explore. Imagine standing on the edge of a bridge, contemplating a jump into the water below. The thrill might be enticing, but the height adds a considerable risk. In investment terms, this imagery aptly illustrates the dynamic between risk and reward. High stakes may yield high rewards, yet they come with increased potential for loss. Conversely, lower risk options might promise safety, but often at the cost of higher returns. Understanding where you stand on this spectrum is pivotal in making informed investment choices. Let's consider some common investment options, each varying greatly in risk and reward. At one end of the spectrum, we have savings accounts and government bonds. These are often seen as the safe havens of the investment world. They offer security with a guaranteed return, albeit modest. This reduced risk comes from stability backed by government assurance or institutional reliability. For someone averse to risk, these options might be appealing. However, the trade-off is that the returns often barely outpace inflation, potentially limiting long-term wealth growth. Moving along the spectrum, we encounter mutual funds and index funds. These investment vehicles blend risk and reward by pooling resources to invest in a diversified portfolio. The diversification helps mitigate risk, because underperformance of one investment in the fund can be balanced out by others that perform well. Still, they are subject to market fluctuations, and returns vary based on market conditions and fund management strategies. For investors willing to assume moderate risk, these funds offer a balanced approach to potential gains. And then we have the stock market, often considered the wild frontier of investing. Here, the potential for rewards is significant, with some stocks offering enormous gains over time. Yet, this comes with substantial risk. Stock prices can be volatile, influenced by numerous factors including market trends, economic forecasts, and corporate performance. Investing in stocks requires due diligence and a keen understanding of market movements. For those prepared to ride the waves, the stock market can be a gateway to exceptional financial growth. At the high-risk, high-reward end, we have speculative investments such as cryptocurrencies and startup ventures. These are the proverbial double-edged swords of the investment world. The stories of overnight millionaires intrigue many, yet these investments can be highly unpredictable. Cryptocurrencies, for instance, are marked by extreme volatility, with prices swinging wildly based on speculation, regulatory news, and market sentiment. Startups, while potentially profitable, face high failure rates, meaning considerable risk for investors. These options require a strong risk appetite and a willingness to accept the possibility of significant losses. When considering risk versus reward, a critical component is the investor's time horizon. Long-term investors can often afford to take on more risk, riding out short-term market volatility in exchange for higher returns. In contrast, those with shorter timeframes may prefer less volatile, more predictable options to preserve their capital. Furthermore, diversification across different asset classes can help mitigate risk while maintaining the potential for reward. By spreading investments, an investor can protect against significant losses in any one area, while still seeking growth opportunities elsewhere. Risk tolerance is deeply personal and can be influenced by factors such as age, income, financial goals, and even personality. Therefore, it's crucial for investors to assess their comfort levels honestly and align their strategies accordingly. Financial advisors can play an invaluable role in guiding individuals through this introspective process, ensuring investment choices match their risk profile and long-term objectives. To conclude, understanding the principles of risk versus reward is essential for anyone looking to invest wisely. Each choice carries implications for your financial future. The key lies in finding a balance that suits your individual risk tolerance and investment goals. By doing so, you can make more informed decisions that pave the way to financial security and success. We hope this exploration of risk and reward in investment options has provided you with valuable insights. Thank you for watching, and until next time, happy investing!